Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Update, April CPI, Yields, Geopolitics, and Tech Earnings. This video presents a direct informational narration of the source document. We'll start our chronological summary with the latest U.S. Consumer Price Index data and see how the major indices reacted.
Here's our structured briefing agenda for today. We will be covering 1. April CPI and Fed odds. 2. Geopolitics and energy markets. 3. Yields and equity resilience. 4. Semiconductor sector divergence. 5. Circle and stablecoin expansion. And 6. Earnings and corporate actions.
Section 1, April CPI and Fed odds.
The newly released inflation data came in hotter than expected. For April, U.S. CPI rose 3.8% year-over-year. That's a new high since May 2023, and it comes in above both the previous month's 3.3% and the market expectation of 3.7%. Month-over-month, CPI hit 0.6%. Looking at core CPI, which excludes volatile energy and food prices, it accelerated to 2.8% year-over-year, marking a new high since September 2025, and posted a 0.4% month-over-month increase. This acceleration reflects pronounced pressures from surging energy costs, which are beginning to transmit into broader categories like groceries and airfares. Because of this, the probability of a Federal Reserve rate cut in December has plummeted to just 2.8%. To put that into perspective, just a month ago, the market was pricing in a 62% probability for a December cut. This sticky inflation data severely complicates Federal Reserve Chairman Wash's stance on lowering rates, firmly blurring the path forward. Section 2, Geopolitics and Energy Markets.
The inflation narrative is tightly coupled with the energy sector, which is currently being driven by intensifying international developments. As reported by Iranian state media, Iran has laid out 5 strict conditions for participating in any future negotiations with the U.S. These include ending wars on all fronts, lifting all sanctions, unfreezing assets, compensating for war damages, and recognizing Iranian sovereignty over the Strait of Hormuz. Former U.S. President Trump stated that these demands are unacceptable. Concurrently, U.S. Defense Secretary Hegseth commented that the U.S. already has plans in place to escalate the situation if necessary. Adding to the energy sector's momentum is the U.S. Energy Department's official Strategic Petroleum Reserve Refill Plan. The department announced it will purchase 12 million barrels of crude over the next 6 months at a price range of $95 to $105 per barrel. In direct reaction to this, international crude prices rapidly surged, pushing West Texas Intermediate crude oil back over the critical $100 mark. This oil price rally has driven up the broader energy sector and really amplified those inflation fears.
Section 3, Yields and Equity Resilience. With inflation data and oil prices rising, the bond market is naturally feeling the pressure, while equities are showing a much more complex response. Global bond yields have broadly trended higher, with the 10-year U.S. Treasury yield further approaching the critical 4.5% threshold. Morgan Stanley analysts suggest that under Chairman Wash, the Federal Reserve might shift to new inflation metrics, reduce forward policy guidance, and accelerate quantitative tightening. This analysis heavily implies that volatility in the Treasury market is going to see a significant increase. Despite this complex macro environment, the equity market's reaction has been quite measured. J.P. Morgan's CPI scenario analysis prior to the print projected that if core CPI month-over-month landed between 0.35% and 0.40%, the S&P 500 would trade sideways, between positive and negative 0.5%. The actual 0.4% print aligned exactly with this baseline probability, and the market followed the script almost perfectly. The S&P 500 experienced a deep intraday dip of 1%, but recovered steadily to close down just 0.16%. The tech-heavy QQQ also managed to reclaim its short-term trend lines, largely supported by the underlying momentum in AI trades. But beneath this resilient surface, structural risks are mounting. Nomura notes that the AI trade momentum, driven heavily by short covering, is showing signs of exhaustion. Furthermore, Bank of America points out that commodity trading advisors, or CTAs, have rebuilt approximately $200 billion in systemic long positions since early April, effectively maxing out their exposure. Goldman Sachs modeling shows that if markets decline, these CTAs could trigger a severe $31.9 billion sell-off over the coming month. This creates a market structure with limited upside and extreme downside tail risks, setting up a potential reversal by May or June.
Section 4, Semiconductor Sector Divergence.
Moving over to semiconductors, the Philadelphia Semiconductor Index closed down 3%, retreating from its highs, but the internal dynamics are sharply divided. Intel stock fell 6.8% amidst rumors that Tesla is transferring its AI 6 chip orders from Samsung to Intel, reportedly under U.S. government pressure. Conversely, NVIDIA continues to defy gravity, posting its 5th consecutive day of gains and closing at yet another all-time high against the broader sector trend. Let's look closer at that Intel dynamic. Beyond the terafab partnership with Tesla, Intel enjoys heavy political backing. The stock's valuation has become extreme. Its market cap has surged by $440 billion since March 30th. Its forward PE ratio now exceeds 100 times, making it one of the 10 most expensive stocks in the S&P 500 by valuation, especially compared to NVIDIA at 24 times. This massive rally has inflicted over $12 billion in paper losses on short sellers, yet short interest remains near a one-year high. S3 Partners highlights that Intel is currently the benchmark for momentum trading and warns that fighting such aggressive momentum can be highly dangerous.
The divergence continues when we compare Qualcomm and NVIDIA. Qualcomm plummeted 11.4% following news that its data center CPUs will be delayed until 2028, leading short-term capital to take profits. In sharp contrast, NVIDIA's ecosystem is advancing rapidly. NVIDIA's Vera Rubin architecture is scheduled for trial production next month and shipping by July. Additionally, NVIDIA has deployed $40 billion in equity investments upstream, solidifying its entire supply chain ecosystem.
Section 5. Circle and Stablecoin Expansion. Away from semiconductors, the digital asset and financial technology space provided notable post-market data. Circle, trading under the ticker CRCL, reported Q1 revenue up 20% year-over-year. However, net profit dropped 15% to $55 million. This drop was heavily impacted by increased equity compensation post-listing. The market largely looked past this, though, focusing instead on the platform's massive growth. USDC balances under custody surged 254%, capturing a much larger share of the circulating supply and highlighting massive ecosystem retention. This positions Circle strategically ahead of the May 14 Clarity Act, which is expected to further define the U.S. stablecoin regulatory framework.
Section 6. Earnings and Corporate Actions.
In the consumer apparel sector, Swiss shoemaker On Holding delivered a highly anticipated Q1 earnings report. Net sales increased 14.5% year-over-year, and net profits spiked 82.2%. Gross margins impressively expanded from 59.9% to 64.2%. Geographically, the Asia-Pacific region was the standout, growing an impressive 44.4%. The company also raised its full-year guidance for margins. But despite all these solid figures, the stock experienced a sharp drop. The primary Wall Street rationale for On Holding's stock drop comes down to supply chain and tariff risks. Both On Holding and Under Armour face significant 20% tariff exposure, as up to 30% of their goods are sourced from Vietnam. This macroeconomic headwind is severely impacting the sector. Under Armour itself reported a massive Q4 revenue miss, pulling in just $1.17 billion against expectations of $1.68 billion, and issued incredibly weak guidance for fiscal 2027 due to consumer weakness and these very same tariff pressures. As a result, Under Armour stock crashed by 16.7%. Over in the M&A space, eBay's board of directors officially rejected a massive $56 billion acquisition offer from GameStop. With the assistance of independent advisors, the board cited multiple concerns. The offer lacked credibility and appeal, featured major financing uncertainties, carried high post-merger operational risk, would introduce heavy incoming debt pressure, and offered virtually no substantive business synergy. Wall Street analysts echoed these exact concerns, and the market clearly agreed with the rejection, pushing eBay stock up 2.1%.
Looking at small-cap earnings, quantum computing firm QUBT saw its Q1 revenue jump to $3.7 million from just $39,000 a year ago, largely due to incorporating revenues from its recent Luminar Semiconductors acquisition. However, it still posted a $4.1 million net loss. Meanwhile, telehealth company Hims reported $608 million in revenue, which is a 4% year-over-year increase, but its net loss widened significantly to $92 million, accompanied by weak forward guidance.
In highly speculative market action, the Destiny Tech 100 fund, trading as DXYZ, plummeted 25.4% intraday. This sharp and unprompted drop follows 2 weeks of extreme, highly volatile momentum trading. So, with sticky inflation, shifting Fed odds, and extreme positioning in key tech names, what defines the true fundamental support of this market? Thank you for joining us for this explainer, and we invite you to share your thoughts in the comments.